So welcome to session 8, the time value of money and compound growth. This is once again a 30 workshop, 30 session series. So one of the most important sessions in the entire series is time value for money and compound growth, right? Why? Because everything in finance, every investment, every valuation, every loan is all based on one simple idea: that money has a time value. So let me start with a question. 10,000 rupees today or 10,100 after 1 year? Which would you choose? Now, most people instinctively say today, but the real question is why? So today we'll understand that deeply. What we're going to cover is why rupee 1 today is always worth more than rupee 1 tomorrow, how money grows through compounding, how to calculate future value and present value. There's something called the rule of 72, then CAGR, compounded annual growth rate, and finally, how investors actually value startups using DCF, discounted cash flow. So by the end of the session, you will start thinking about money like an investor. So moving on to the next slide, let's quickly, recap the previous session as always. The previous session, if you may recall, was on unit economics. Let's start with the CAC, the CAC, customer acquisition cost. Now, how do you calculate it? It's very simple. Take the total sales and marketing spend and divide it by number of new customers. And we have our classic study AI case. There were two kinds of CACs that we actually, one was the paid one, which was 74, and the second one was the blended 40, right? So the important insight is you must include every rupee spent, not just advertisements. The second thing that we learned was LTV, lifetime value. And we saw this, the ratio between CAC and, not in fact CAC, but LTV and churn, right? Which was inversely proportional. So LTV is the contribution margin per customer divided by churn rate. Take the same example. Okay, contribution margin was 92. If you recall, the selling price was 99, right, per download, and then 7 rupees was going to the payment gateway. So you subtract. So you get 92 and you divide by 3% churn. And that gives you rupees 3,067. That's a lifetime value. Now, here's a powerful insight. Reducing churn by just 1% increases lifetime value by 33%. And that's why churn is the most powerful lever. The third thing was the ratio. LTV to CAC ratio. Study AI has 76.7 times, which is exceptional. That means the business can scale confidently. Now, everything we learned today builds on this because investors evaluate all of this using one principle. It's called time value of money. So let's quickly look at the entire session, what we're going to cover. We start with the hook, the same question, 10,000 versus 10,100 rupees. Then we go into the core idea, why money today is more valuable than money tomorrow. Then we move to future value and present value, the two most important formulas in finance. Then we understand compound interest, often called the eighth wonder of the world. Then we learn the rule of 72, a mental shortcut to double money. Then CAGR, how to measure real growth. And finally, an introduction to DCF, which is how investors value startups. So by the end, you'll be able to calculate future value and present value, apply rule of 72 mentally, understand compounding deeply, calculate CAGR, and understand startup valuation logic. So let's revisit that question, 10,000 rupees today or 10,000 rupees after 1 year. And most people will say 10,000 rupees today. But interestingly, the smartest answer is it depends. Depends on what? Depends on the return you can generate. Okay, so I'll just move to the next slide. Again, the same question, and let's dissect it. let's understand there are three core reasons why people choose it today. First could be the opportunity cost, because rupees 10,000 today can be invested. It's there, the money is there. And at 12% return, for example, what you get? You get 11,200, which means 1,120 extra. Okay. So if you wait for 10,000, 100 rupees for the next year, right, you're actually losing 1,100. Okay. Second one is the inflation. Money loses value over time. And at 6% inflation, 10,100 in 1 year will actually become 9,528 in today's value. So the denomination remains the same, but the purchasing power, if you look at, becomes less. The third one is the risk. Future is uncertain. You may not receive that money. It's just somebody made a promise, but people can break promises. So you demand a higher return to compensate for risk. Now, this leads to one powerful conclusion. And this is a very important sentence that I said, because investors also do, because they don't know when the money will come back. Okay. Yeah. So what is that powerful conclusion? It's very simple. Rupee 1 today is always worth more than rupee 1 tomorrow. And the idea is very simple. It's TVM, time value of money. This is the foundation of all finance. Okay. So two formulas that we're going to study, right? And this is important in every financial decision in the world. Okay. What are those? First one is the future value. How do you calculate future value? It's very simple. Future value is equal to, which is FV, is equal to present value, PV, multiplied by 1 plus R, which is interest rate, and raised to the power of n, which is number of periods. Now, this number of periods can be years, can be months, whatever. Let's take an example. If you invest 50,000 rupees at the rate of 12% for 3 years, okay? And let's do a very simple math. So we will divide this n into first, second, and third. When you do it for the first year, your n becomes 1. Put that value there. 12% becomes 12 by 100, which is 0.12. So within parentheses, you get 1.12. So 50,000 into 1.12 is 56,000. First year, this is what? So 6,000 rupees is what you've gained. Now, you reinvest the same 56,000 and you do it for the second year. So here also the n will be 1 and not 3, because you've already done the for the first year, right? So it's 1.12. So you get 62,720. And then you do it for the third year, because now you have achieved for the second year. So for third year, your PV will be, the present value will be 62,720 multiplied by 1.12. What you get is 70,247, which means today you can actually calculate this 50,000 rupees at 12% after for 3 years will become 70,224. Okay. Now let's take another example. The monthly recurring revenue, which is 1,34,107. I think in the previous session we already did. Right. And this is growing at 8% per month for 6 months. So do it for simple calculation. Future value, take the present value is 1,34,104 multiplied by 1.08. 8% becomes 8 by 100, which is 0.08. And your n becomes 6. So the value that you're going to get is 2,12,893. And this is in terms of month, right? So that's compounding in action. Okay. Now, if you have to calculate the present value, it's very simple. Present value will become future value, and you divide by 1 plus R raised to power n. Or what you do is future value multiplied by 1 plus R raised to power minus n. It's one and the same thing. Now, let's take the example. 10 lakh rupees after 3 years. Discount rate is 20%. And we now call it as discount rate. Okay. So this 10 lakh rupees, what you're talking about, is actually future value. Okay. It's not the present value. Now with this, we're calculating the present value. So of course, the rate will be reduced. So we call it as discount. If you start with the present and go towards future, there'll be a rate. So it is increasing. And put the formula 10 lakh rupees divided by 1.20 raised to power 3. And 1.20 raised to power 3 is approximately 1.728. And then you divide it. You get 5,79,000 rupees approximately. So 10 lakh rupees in future, which is, what is that future? 3 years, is worth 5,79,000 today. Okay, at a discounted rate of 20%. Now you understood. So final insight is every valuation is a present value calculation. Correct. So now we move to what is called the eighth wonder of the world. That's the compound interest we're going to study. And this is where money stops growing linearly, right? And it starts actually growing exponential. So exponential growth is faster and it's really, really amazing. The difference is very simple. Simple interest actually adds, but compound interest multiplies. And over time, that difference becomes massive. Therefore, in mutual funds, SIP, if you know, it's all about compound interest. The longer the time horizon, the bigger the gap. Okay, so let's now look at carefully with some of the numbers and look at this entire table. We start with 1 lakh rupees at 12% per year. Okay, and let's compare simple versus compound. We have taken different years. We'll start with year one. So at year one, if you calculate the simple interest, the formula is PRT by 100. You may recall what you studied in your, school time, right? Okay, P is the principal amount, R is rate of interest, T is the time. So so you get 1,12,000, and if you apply the same compound interest, right, which is again the same. So 1, 1, 2, 000. So there's actually no difference, right? But let's increase the year. Now the year is 5. In case of simple interest, you get 1,60,000. In case of compound interest, it's actually 16,234 more, which means it's 1,76,234. And what we're calculating is actually the entire thing, right? Now let's move. So year 10, it's very simple. 2,20,000 is a simple interest one, and then the compound interest one, it's 3,10,590. Look at the gap. The gap is actually widening. It's increasing 90,585. Now, if this becomes 20 years, you see the gap. In case of simple interest, it's 3,40,000. Case of compound interest, it's 9,64,629. So there's a difference of 6,24,629. Okay, it's not just increasing, it's exploding. And 10 more years if you add, for simple interest, it's 4,60,000. Compound interest is nearly 30,000, 30 lakhs. And there's a difference of 25 lakhs nearly. This is called the power of compounding. You see, the longer the periods are, the longer is the value that you get. So understand the formula. Okay, very simple. P into R plus 1 raised to power n and PRT by 100. That was a simple interest case, right? So what did you learn? What's the key insight? In compounding, interest earns interest, and that's why time is the market. Time in the market actually beats timing the market. Now we will discuss about the rule of 72, a very powerful shortcut. And the formula is very simple. It says years to double. Your money will actually get double. So how many years it will take? Okay. If you have to find out that, right, just take the value 72 and you divide it by interest rate, nothing else. So for example, let's apply it 6% interest rate. Okay. So 72 divided by 6 is 12 years, which means 12 years it will take for your money to double. Now, what is your money? If you start with 10,000 rupees, it will become 20,000 rupees, right? After 12 years at a rate of interest 6%. Okay. If you take 8%, for example, You divide 72 by 8, which is 9 years. You take 12%, you will get 6 years, right? You take 15%, you get 4.8 years. You take 24%, you take 3 years. Okay, it's very simple, right? Now, if you do the actual math, you won't find exactly 12 or exactly 9, but it will fall in those years, right? That's how it is. So, for example, in case of 15, it's 4.8 years, not exactly 5 years, but mid fifth year, you're actually going to do this. Okay. Now, look at the power of time. If Aryan starts at an age of 70, by the time he's 23, right, it's 2x. By the time he's 29, it's 4x. By the time he's 41, it's 16x. That's called the exponential growth. Okay. Now compare some FDs. It's like randomly, I've taken examples. So you have an SBI FD, which is, I think, usually at 6%. Okay. So 1 lakh rupees becomes 4 lakh in 24 years. Got it? You take Nifty, right, at 12%. So this 1 lakh becomes 16 lakh. Okay. It's very simple. Now, same time, different rate, massive difference, right? So final insight is time is the only advantage you cannot buy. Okay. So the question here is, how fast are you actually growing? Is there a way? So there's a fundamental way through which we actually calculate, and that's called discounted cash flow. Okay. What are future cash flows worth today, kind of? So there's a formula, and the formula is very simple. You take DCF is equal to CF1, this cash flow for the first year, divide by 1 plus R to the power 1. And likewise, for every year, you just increase the power and you add all the terms. Let's do a calculation. Okay. Now we move to CAGR, which is the compound annual growth rate. We'll use the same formula. So CAGR is ending divided by beginning. Very simple. Ending divided by beginning raised to the power 1 by n minus 1. Got it? So beginning is 19,800. Ending is 1 lakh 18,800. So if you may recall, what are these values? The first month value was 19,800, the revenue. The sixth month was 1 lakh 18,008. So that's how it is. Okay. So if you divide this, you get 6. Okay. Now that's a step 1. Okay. Now take 12th root. Okay. Since there are 12 months, so it's very simple. So 6 into 1 by 12, okay, which is equal to 1.162. And then from this value, 1.62, you have to actually subtract. I'll repeat it. Look at the formula very carefully. Ending divided by beginning raised to the power 1 by n minus 1. So there are 3 terms here. So first we'll do the ending by beginning, which you will get 6. Right now 6 raised to power 1 by n. So why we are taking, because there are 12 months, right? And you get the value 1.162. Then you subtract 1. You get the CAGR as 16.2% per month. And if you have to do it annualized, it is 561%. So now from year 1 to year 2, okay, just see year 1 to year 2, rupees 53.8 lakh rupee, right? Divided by 7.7 lakh, because that was the first year. You get nearly 7. Okay. And CAGR is 599%. So the critical insight is simple averages lie, right? Example is plus 100%, then is, minus 50%. Simple average is 25%. But actual growth is 0%. So CAGR gives the true answer. The final insight is investor always, look at the CAGR. Now, why your future profits are worth less today? That's the question. Okay. And we have a very simple thing to explain to all of you. We've already discussed that formula. DCF is equal to CF1 divided by 1 plus R raised to power 1. Likewise, you keep adding the terms. So for first year, if you just put it, you will get um, 28 lakhs, right? Your discount factor. So this, what you call 1 over 1 plus R raised to power 1 or raised to power n is the discount factor. So at 20%, you can actually do, because rate is 20. So 1 over 1.2, which is 0.833, right? And you get 23 lakhs 33,333. For year 2, let's calculate it. Okay, CF2 is 64 because that's what you're seeing the cash flow, right? 64 lakh. And the factor is 1 by 1.20 to the power 2, which is 0.694. And similarly, right, you can and then therefore you can calculate the present value. Okay. Then you can do the third one, which is for the third year, it is 1 crore 20 lakhs. Okay. And your factor is 0.579. So your present value is 66,944,444, right? If you add all these, you'll get 2.12 crores, right? This is the future, okay? So total present value will be 1.37 crore, meaning 2.12 crore in future is actually 1.37 crore today. So 1.37 crore today is actually 2.12 crore in future. Okay. That is after 3 years. Now the key insight is higher risk, higher discount rate, lower valuation. Example, 30% discount rate reduces value by 35%. So what is the final insight? Investors are buying discounted future cash flows. So what did you learn? Let's recap. Rupee 1 today is more than rupee 1 tomorrow. Future and value and present value formulas drive all finance. Rule of 72 gives quick doubling. 72 divided by that rate of interest, if you may recall. CAGR gives the real growth. Okay. Then these are not formulas. These are just thinking tools. So what you are expected to do, let's say this week, apply, right? Check your interest rate, then rule of 72, calculate FV of your savings, calculate CAGR of your business, evaluate investor offers using PV, and most importantly, start investing, maybe even 500 rupees per month, whatever. I'm not giving you any idea, any suggestion which SIP is good or bad, but yeah, start doing that. That can help you. So because compounding starts only when you start, right? So that's all, right? We have reached to the final part. Okay. And in the next session, we will definitely come back. Okay. So I'll just want to close with, one powerful idea. The best time to invest was 10 years ago. The second best time is today because we have learned today. Okay. At 12% return every year you delay, right, costs you 12% of your future wealth. Waiting 5 years can cut your wealth almost in half. So remember, every rupee has a timestamp. Start early, start consistent, and I'll see you in session 9. If you've liked it, please subscribe it and do share it with all your friends, members. Thank you so much for watching.